Welcome back to the channel. In this video, we're taking a look at crypto and the macroeconomic situation. So hopefully going to fill in a little bit of color as to what's going on with macro right now. It's clearly macro matters. We are heavily correlated to the equities market, which is being driven by the Fed. So any decisions that the Fed makes clearly impacts us here in crypto land. So we're going to jump through a few threads here of interest and try and piece some of this together. So if you enjoy the content, make sure you subscribe to the channel, and we're going to hop right on in. So a thread here from Jonathan Cheeseman of FTX Exchange with his own perspective. So he says global rate markets are tightening, but perspective is required. So the acceleration of rate of sell-off in the past few trading sessions has been striking, particularly in the absence of new news and over a holiday weekend and a Fed blackout period nonetheless. As the market is seemingly pricing in the worst case scenario here, 5-year real rates are 80 basis points in 2 months only, from 1.9 up to 1.1. And while the rate sell-off has been across the curve, in the last week we have been removing some of the flattening. This is challenging the idea that this will be a very quick and shallow tightening cycle. So he's pointing out here that the tightening regime may be a short-lived one, as we're already seeing the markets move down quite significantly without any actual action taking place yet. This has coincided with calls for the Fed to end quantitative easing early on January 26th. This is the next meeting for the FOMC, and hike rates by 50 basis points, 0.5% in March, as there's warnings they are behind the curve and inflation is out of control. So he says this is some of the speculation in the market right now, but let's have a look at these points separately. So Jerome Powell spoke 1 week ago and was pretty measured, giving no hint of ending QE early, or that a 50 basis point hike was on the table. He was also very clear that while stubborn, they believe we will start to see inflation ease as supply corrects. So they believe the inflation is supply driven, not demand. And March is still a long way away, so he's not ruling anything out here. But even Waller, one of the most hawkish on the committee, was pretty clear that last week they wouldn't start with a 50 basis point raise. So this is Waller's statement. I don't see a 50 basis point hike coming in March. We have not prepared the markets for anything this dramatic, and one of our key themes has been to not surprise the markets, giving well advanced notice. So while the markets may be pricing in this worst case scenario of 50 basis points, this does seem highly unlikely. But down the road, if inflation just does not look like it's coming down, it certainly would not be off the toolkit. So 50 basis points could occur, but that is unlikely for March. And on the inflation side of the table here, he's saying this is more concerning. As the market prices more hikes, it's taking the view that central banks are misreading the risks here. So the risks here are that energy, housing, auto prices are certainly spiraling and squeezing Main Street, i.e. we have less money to spend, less disposable income, due to the fact we're seeing drastic rises in things that are out of the control of the Fed. So increasing the interest rates obviously squeezes demand side. That is what they can curb by utilizing rate hikes. But clearly, if things like your energy bills have gone up 2-3x over the last year, this is something outside of your control. You have to meet those payments. This just squeezes your overall disposable income, and thus there is going to be less demand-led inflation. So as Jonathan Cheeseman points out, there's not much the Fed can do about oil, and this also does that tightening, so Jay Powell doesn't have to. Gas prices are almost doubled in the last 12 months here, and now looking at what's priced for 2022, we're pricing 105 basis points for the Fed and even 20 basis points for the European Central Bank, who have been resolute in that they won't raise rates. Even before the end of quantitative easing, MBS, which is mortgage-backed securities, is under significant pressure. So pointing out the toolkit that is at their disposal may not actually be required. Yesterday's Empire Manufacturing printed a post-pandemic low down to 0.7. And if we just scroll down here, this is a take from Raoul Powell, suggesting a shallowing tightening cycle. So let's have a little look at Raoul's thread here, my go-to for macro. So there's something interesting about this rate cycle in the yield curve. Normally it doesn't really flatten until a couple of years post-recession, and normally at 250 basis points, this level up here, 2.5%. Now this could be a correction, but if it breaks this line by here, it suggests a shorter cycle than normal. So he then goes on, this doesn't mean a recession is imminent, but it means that the bond market sees less ability to tighten without slowing growth. We saw similar in Japan's yield curve in 2010, lower than the usual 150 basis points, and the Japanese bond yields never recovered from then. So he's saying no action points right now, but just observing if the yield curve in US flattens, breaking the line, it suggests that rates can't rise much and that this will shift equity market structure back to long duration growth as GDP growth is less likely to be supportive of cyclicals. So Raoul's sitting in the camp that they can't raise rates all that much. In this video here, which was Friday, on Real Vision on the YouTube channel, he disclosed that he thinks that they will do 2 hikes, but possibly just the 1 in 2022 due to the fact it won't actually be required. And he thinks inflation by around June time will be down to around 3%. So he sees this as supply-led inflation and that things will start to sort themselves out without the Fed having to do too much intervention in terms of rate hikes. And he doesn't see them tightening any quicker than what they've already projected to the markets. And an interesting point he makes in that interview there is the fact that consumers aren't spending much money anymore. Post-pandemic, people aren't going out socializing as much. They're not spending frivolously as they were previously. And so raising interest rates curbs demand further. But if demand isn't actually that high anymore, then this may be a part of a toolkit that is not required. Now back to Jonathan's thread here. Thinking about positioning in the most rate sensitive sectors, the market is very clearly long financials and underweight tech and short rates themselves. And then he posts ARK Invest. So Cathie Wood's fund here is off 50% from its highs. And her portfolio is very heavy in high growth and disruptive tech. So he says, in summary, we're already pricing in a lot and positioned for these moves to extend. But be careful. Think about those warnings of a big correction or goading the Fed. Many of the people doing this are also the ones with the deepest pockets. Looking globally, the People's Bank of China and Bank of Japan both sound pretty dovish too. So he's suggesting those making all the waves here. Impending crash, the Fed's going to crucify the markets, while those are probably people sat with billions of dollars on the sidelines, ready to scoop up any capitulation events. Mr. Captain Rational, Noah Seidman here. Max Payne may be markets trending horizontal and at these valuations for the coming months until the Fed capitulates, as there's no way to juice GDP growth without continuous fiscal intervention. Stagflation or deflation with permanent Fed acronyms stabilizing global collateral and dollar demand. And he says that this is all about optics. The government actually fears deflation more than inflation. The only reason inflation is a hot topic is purely the political optics. So maybe the Fed is just biding their time before maybe juicing the markets once more. But of course, macro is wider than just the US. So let's look at PBOC here, People's Bank of China. So the Chinese property stocks and bonds jumped for a second day after the central bank pledged to use more monetary policy tools to spur the economy and ease credit stress signs as the real estate market slump worsens. So 7.1% was a gain posted just yesterday by County Garden Holdings. And that coming off the fact the People's Bank of China cut rates on Monday for the first time in almost 2 years. So they had some growth across the board over the last couple of days, and China's central bank pledged to use more monetary policy tools to spur the economy and ease credit stress. The People's Bank of China will open monetary policy box tool wider and maintain stable overall money supply and avoid a collapse in credit. So this is definitely more dovish. They want to continue easy credit and ensure there is no collapse. And the central bank will roll out more policies to stabilize economic growth, front-loading actions and making preemptive moves. It will address common concerns in the market in a timely manner and stay ahead of the market curve. So it sounds like they're ready to juice things up to ensure they do not get a worsening economic situation. So it does sound like there's undertones here of further stimulus from other regions. Bank of Japan raises inflation forecast but rules out policy tightening. These guys have a lot lower levels of inflation in Japan. Their governor here, Mr. Kuroda, acknowledged that price pressures were rising, but said the central bank had no intention of raising rates with inflation projected to stay below 2%. That's its goal for years to come. And we're not debating an interest rate hike. He says the median forecast is for inflation to move around 1%. And under such conditions, we are absolutely not thinking about raising rates or modifying our easy monetary policy. And then interestingly enough, if you read further onto this article, Economic Outlook, Japan's economy says that the recovery was becoming clearer and that post-pandemic problems were starting to ease. And even with spikes in the new Omicron variant, they were taking these in their stride. And there was a more upbeat assessment. And it says the economy was picking up as a trend. So we might see a bit of growth in markets as the pandemic draws to a close potentially, with Omicron potentially being a bit of a silver lining, as it seems to have really quickly run its course and not had such detrimental effects as previous variants. So the FOMC will meet on January 25th to 26th, 1 week's time from today. What do you guys think that they will do? Are we going to see some more dovish posturing rather than hawkish? It's been all very negative for the last 2 months. And in reply to that, the SPX has come down from around 4,800 to around 4,600 and is in a bit of a free fall at this moment in time. And the Bitcoin market, of course, pretty much correlated, down only since November. And if we just go into the 4-hourly chart, we're in a pretty precarious place here, hovering in this channel, which for me is kind of make or break. If we just start closing below here, I think we're going to go and really run and sweep those real lows again around the low 40 to high 39K region. But if we do get some more positive news of some sorts, or the FOMC comes out with some statements that aren't as hawkish, or at least are dovish in some fashion, maybe we can start to run it back and get some closes towards the mid 40K region, which would be a nice bounce from here. We just haven't seen any form of sustained bounce for such a long time now that it does seem that we are overdue one. So whether these guys can actually continue with their hard stance, or whether that has been purely optics up to this point, well, we will just have to find out over the coming weeks. But you can see there are some silver linings out there with other regions of the world, and some of our favorite commentators here being somewhat more positive that there will be a better way out from this after just purely negative stuff and continued bearish sentiment across the market. It's actually quite difficult to find people who are positive at this moment in time, which often does mean we could see a bit of a reversal. But I hope this has covered some of the topic areas of concern right now and filled in a little bit of color here and there. I'm by no means an expert in economics, but I can see from what's portrayed here that things might not be as bad as first thought. So if you enjoyed the content, make sure you subscribe to the channel, and I will catch you guys in the next one. Goodbye.